What kind of revision to the dots do you expect that we'll see tomorrow?
Well, we might see a small shift down in the remainder of 2017, but I think if you look at how the median's put together, I mean, the bar's pretty high to take that third hike off the table for December. Certainly the markets think that's better than a coin flip at the moment, and I think economists are somewhat more constructive on a rate hike. I think we may well see a shift going into 2018. It could well be that we see that first hike implied for March of next year, shifting back maybe to June. And it could well be that we see a further trimming of that long-term interest rate from 3%.
Yeah, Matt, I want to pick up on the long-term interest rate, because you had a chart in one of your notes, and we recreated it on the Bloomberg here, taking a look at what the market thinks that neutral rate's going to be, which is the yellow line, and what the Fed thinks it's going to be, which is that blue line. What do you see, and why is the gap so significant?
Yeah, absolutely. I mean, the reality is I wouldn't characterize the gap as all that significant. The market is generally a lot more volatile than the Fed is when they think about the long run. And so what you see here is ultimately that there's a little bit of risk premium still in the back end of the curve, relative to previous very large sell-offs that we saw in the wake of the taper tantrum in 2013. We also saw a big market reaction in the wake of the presidential election. Every time we had those big moves higher in yield, you got to about 75 basis points over the Fed's longer run dot. Well, now we're sitting about 20 basis points above it. And look, if the Fed does lower their longer run dot today, it's going to make the long end of the yield curve look more attractive to investors who would naturally need to be there anyway. So from my perspective, the risk to this meeting, and I agree with the other speaker, the risk to this meeting is that the dots in the back end of the curve come down. It doesn't take that many. It only takes 2 dots in the long run to come down to shift that longer run rate from 3% down to 2.75.